Hi, I'm Pete Mitchell with an introduction to the stock market, what it is, how it works, and how to get started. If you're confused or unsure, you're not alone. In fact, it's amazing to me how many adults, many of them college grads, practically know nothing about the stock market. Many schools simply don't offer or don't require classes that cover it. So if you've been holding off on investing because you simply don't know enough about it, that's probably wise. But rather than delay any longer, here's some information to get you started. The nuts and bolts. Basically, if you own a stock, you own part of a company. If you're invested in that company, if the company does well, the value of your stock tends to rise. If the company does poorly, the value of your stock tends to fall. The value of stock, or the share price, is determined by supply and demand. When more people want the stock, perhaps because it's doing well, the price goes up. When less people want that stock because they see less value in the company, the price goes down. That is the stock market in the simplest of terms. When you hear the market, think of it like a flea market. Rather than travel all over town, a flea market offers you a central location where buyers and sellers can meet up. The stock market isn't all that different. Stock markets are simply gathering places for stock owners to buy and sell stock securities. Heard the term exchanging or trading? These are terms you hear frequently in regards to stocks, but they can be misleading, and perhaps this is one reason there is so much confusion. You see, you're not actually exchanging stocks, and you're not really trading stocks. You're simply buying them or selling them. So how much does it cost to buy or sell a stock? Actually, there are two costs to consider. The cost of the stock and the cost of the trade. The price of the stock varies hugely from company to company and can change from moment to moment. So that's an answer or a question I can't answer for you here. But there's a fee to buy or sell a stock or a share. The amount of the fee depends on which stock brokerage you use. Generally, these fees can range from under $10 to $20 or even up to $100 per trade. Keep in mind, you'll pay a fee when you buy your stock and again when you sell it. So what is a brokerage? A brokerage is a conduit for buying and selling of stocks. For example, let's say you want to buy a stock that's listed on the New York Stock Exchange, the NYSE. Well, that stock is bought and sold on the floor of the NYSE. So unless you're authorized to trade at the exchange and want to travel to New York, you instead enlist the services of a broker to take care of your buying and selling for you. The brokerages pay fees to become members of a stock exchange and therefore have access to the floor of the exchange for trading. Then they buy and sell stocks on behalf of their clients, meaning you. So how do you get started? There are all kinds of ways to get started and a myriad of brokerage choices, including discretionary dealing. This is where the brokerage chooses stocks on your behalf. Advisory dealing, where the brokerage gives you advice but leaves the decision up to you. And execution-only brokerages, where you'll be entirely self-directed. Most brokerages have a minimum deposit you must make in order to get started, so you'll want them to look into that as well. If you're serious about investing and want to do it frequently and avidly, read up on the markets and consider taking a class to educate yourself. So what is Pete Mitchell Inc.? My company is what's called a registered investment advisor, or an RIA for short, not a brokerage. Now me personally, Pete Mitchell, I am an investment advisor representative of my company. Even though there are many, the principal difference between an RIA-only firm and a brokerage firm, or also called a broker-dealer, is that we do not earn a commission or charge a fee to make trades for you. We charge a fee for our investment advice. Now, that may not make a lot of sense to you, so let me explain. Stockbrokers typically earn a commission when they sell you a product like a mutual fund. After you're in the product, little, if any, additional commissions are paid to the broker. This means that the stockbroker does not have the same financial interest that you may have when it comes to investing. My type of firm charges a fee based on the assets we manage. This is typically a percentage of the account, somewhere between 1 to 1.5% as a whole. We get paid 25% of this fee every quarter. So if your account goes down because of either what's going on in the market or for some other reason, our paycheck goes down as well. So here's my question for you. Who is more likely to be concerned with what's happening in your account? The guy who got paid up front, or the guy who loses when you lose and wins when you win? It's a rhetorical question because I think you know the answer to that. In summary, before you make any big decisions, though, think about enlisting the assistance of a qualified financial professional who can give you insight and perspective on the financial markets. I'm Pete Mitchell, and I look forward to sharing more on investing with you later.